Portfolio Builder members, we had a great weekend, and thanks to this absurd chart with the SPY ETF just skyrocketing up, even though there's tons of bad economic data flying out, everyone thinks the central banks are going to keep propping the market, and that does seem to be the case, and why we've been bullish with our strategy. So today we're up quite a bit. We're going to have to buy back our covered call for a loss and then let the underlying asset deliver the big gain. And also, for those of you who cannot afford to purchase 100 shares of the SPY ETF, we are also going to give you a trade alert today to follow the TBT ETF, which has actually delivered us twice the return as the SPY to date, as the yield has been more consistent and the volatility in the underlying asset has been more steady. And even though that looks like a big jump up and down, we're only talking about a $1.50 jump from this top to this bottom. So let me take you through today's trade alert line by line, explain how to read it and how to input the trades into your own spreadsheet and get started. And don't forget, we have a live webinar, so you got this video recording to step you through the trade alert. And if you have more questions, every Monday, Wednesday, Friday, right after all this content is released, we launch a live webinar to answer even more questions. So we have two strategies, the rich man income system and the poor man income system. First, we'll cover the rich man income system, which requires that you purchase 100 shares of the SPY ETF. Now, in general, our goal with this strategy is to earn a 0.35% return every 48 hours from writing a covered call. And that's what we can make if we do it right at the money. Now, there will be cases where I predict that the SPY ETF will go up in the next 48 hours. And if that's the case, we'll take less credit and write a covered call at a higher strike price. And then we can actually make more than 0.35%. if we anticipate that. And in the same breath, if we think the market's going to go down in the next 48 hours, we can write the strike price lower, and our total portfolio will actually go up even if the stock market goes down. Okay, so let's go through our trade alert line by line. In this example, we're showing you the return of 0.35%. So if we take in $100 credit, writing a covered call, that's in the money, which is something you can do every Monday, Wednesday, Friday with a tremendous amount of capital in the SPY ETF. That's a 0.36% return. Now, today's trade is a little less than that, but we can make even more money if the ETF, the SPY ETF, goes up by Wednesday. But I want to point out the return that can be generated from this being just done almost mindlessly, right at the money or just slightly above the money covered call. So if we do this 150 times, that's 3 times a week, 52 weeks a year. We threw 6 weeks out the basket. We're assuming the SPY ETF trades flat. Of course, it's not going to trade flat. It goes up, it goes down. We like the S&P 500. When we're looking at retirement income, when we're looking 10, 20, 30, 50 years down the road, when we're looking at being able to pass your assets on to your family, the S&P 500 is a safe place to put your money. And most likely, the top companies in America will continue to grow. They'll generate more and more profits. And in the long run, your underlying asset will go up in value. But let's look at the type of return we're making from doing a covered call 3 times a week. This does not assume the underlying asset goes up or down. Just a 0.35% return compounded 150 times turns a $27,670 investment into $46,732. And that's in 1 year. So that's a 68% return in 1 year. Now that's if you don't spend the capital as fast as we're making it. Now let's say we just spent the money and didn't reinvest. So that's $100, 150 times a year. That's $15,000 of income from a total investment of $27,670. Now that's at current volatility yield rates. Now the yield can go up and down as the volatility on our underlying asset changes. So if you were to just take the income and spend it, we're still looking at a 54% return over the course of a year. Now, over this weekend, because we're covering our covered call for a loss and the underlying asset went up, we ended up netting about a $5,000 profit on a model portfolio of $500,000 for a 1% gain over the weekend. Now, this doesn't happen all the time, but this is growing at a rate that's 200% faster than we just hypothesized up above. So if the SPY ETF goes up, then that's very good for both our portfolio and the gamblers who want to buy our covered call option. Okay, so let's look at the trades we actually put in. Okay, so here's the SPY ETF. Right now we're bullish. There's a big event happening Friday where a ton of option contracts expire, and the probabilities, just looking at statistical analysis of all the years in the past, there's two things in our favor for the SPY ETF this week. One, last year at this exact same period, the stock market went up considerably, so all the algorithmic computers are looking back at that and saying that's in the odds again this year. And then on the same note, this event typically has a run up into the option expiration and then a big sell-off. So starting Friday, we're going to become a lot more bearish. We're also worried about corporate buyback blackout period. So you'll see the strike price is going to start sinking lower and lower as we get into the Ides of March. Here's the math of what happened over the weekend. Now, do realize last week there was a sell-off, so our portfolio did give up some of its profits during that period, and this strategy is not completely 100% bulletproof. It does help take out some of the sting when the market's going down. Our covered calls reduce losses, but when the market's going up, our covered calls can reduce the potential gain. So our ability to predict the movement over a 48-hour period can help enhance our returns. So to summarize, we were looking at the SPY ETF at 273.18 last Friday, and we collected a 48-cent credit per share writing a covered call that would expire today. And that covered call was for $275. Now we could let this go into assignment overnight, but what we're going to do is take a loss, buy back our covered call, and you'll just do that at market. If the market's gone up higher, by the time you got our trade alert, you may have to pay more, but your underlying asset will have also gained more. Once you look at all the credits and the gain in the underlying asset, we ended up with $5,287 profit on the model portfolio over the weekend. So again, that's a return that's 200% faster than hypothesized up above, just to get a above 50% year return. Of course, our biggest fear is if the underlying asset goes down, and we can protect against that in a number of ways, namely buying put options on other assets like the QQQ, and by writing our covered call strike price below the trading price. And in that event, if we can calculate just how fast it's crashing, we can actually make money in both directions. So scrolling down, if you haven't bought your shares yet, the first step is to get at least 100 shares of the SPY ETF. That gives you the right to rent out your shares for income. Okay, so here's the trade alert of buying back the position. Here's the trade alert that we're opening up, expiring Wednesday, to bring in more credit, slightly above the trading price. So this was trading at 277.36. And we wrote it at 278. Here's the option contract. Actually, that has to be fixed. And continuing on, we'll now go to the TBT position. TBT is a inverse ultra short Lehman 20-year Treasury ETF. Essentially, we're betting that the 20-year bond rate will go up. So if the yield curve continues to steepen, which the Fed appears to be actually trying to make happen, this will be a very profitable long-term strategy. It's basically completely designed around Jeffrey Gundlach's prediction that this long-term yield will eventually rise up to 6%. If that's the case, this underlying ETF will not trade at 35, probably closer to 140. And in the meanwhile, we are writing the covered calls. So if you missed Friday's trade, the current trade I'm doing is just right above the current strike price. So once I think the yield may go down a little bit, that would make the TBT go down. We'll do the same thing. You'll see most likely, while these two ETFs are very correlated, when we're writing strikes above the trading price on the SPY, we'll be doing the same on the TBT. Once we're getting a little more bearish on the stock market, that will also potentially correlate to a bearish scenario for the TBT, and we'll start writing the strike price slightly lower than the trading price. So this one will collect $15 from every $3,500. And if you use a phone app called Robinhood, you can do these trades for free. This ends up with about a 50% return. So if we look here, the Friday trade alert made about 25 bucks for a 0.94% return. If you do that over 52 weeks, you generate a future value of $5,700. Which is a 62% return. Now, if the underlying asset goes up and we're writing our strike price above the trading price, we can also enjoy some of the underlying asset going up in value. Okay, to wrap up today's video, and then I'll be hopping on the live webinar, what we're going to do is close out this position and write the new one. So for you guys, you can just paste it at the bottom. And it will work fine.